Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CENTESSA Pharmaceuticals PLC annual report. CENTESSA Pharmaceuticals PLC is a clinical stage pharmaceutical company that provides various medicines and services to address different health needs. The company's lead clinical stage program includes ORX750, which is being studied for the treatment of idiopathic hypersomnia and narcolepsy type 1 and 2. In addition to its research programs, CENTESSA offers LockBody, a service designed to selectively drive potent effector function activity into the tumor microenvironment. This innovative approach has potential applications in treating various types of cancer. The company is also developing Zone 142 for the treatment of neurological and neurodegenerative disorders, including excessive daytime sleepiness, impaired attention, cognitive deficits, and fatigue. Furthermore, CENTESSA is working on ORX489 to address neuropsychiatric disorders. Overall, CENTESSA Pharmaceuticals PLC's diverse portfolio of medicines and services aims to improve human health by addressing a range of medical conditions. CENTESSA Pharmaceuticals PLC maintains a market capitalization of $6 billion, broadly in line with the industry peer group. CENTESSA Pharmaceuticals PLC trades at a higher price-to-book ratio of 17.71 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 23% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for companies can be broadly categorized into two main groups: common drivers and company-specific drivers. Common drivers include regulatory approvals, successful commercialization of products, milestone payments, royalties, and collaborative arrangements with other companies. Regulatory approvals are a significant driver of revenue growth as they enable companies to bring their products to market and generate sales. Successful commercialization of products leads to future economic benefits and revenue growth. Milestone payments contingent upon regulatory approval, sales milestones, or development milestones contribute to revenue growth. Royalty payments on net sales of products are also a significant driver of revenue growth. Company-specific drivers, on the other hand, vary depending on the company's business model and strategy. For example, Genmab's license agreement is a significant driver of revenue growth due to upfront payments, potential payouts for development, regulatory and sales milestones, and tiered royalties on annual global net licensed product sales. However, there are also challenges that can impact revenue growth. Regulatory uncertainty, unfavorable clinical trial outcomes, and increasing compliance costs can all negatively impact revenue growth. Additionally, financial metrics such as revenue recognition, net operating liabilities, and depreciation expense can also impact cash flow and revenue growth. In conclusion, the primary drivers of revenue growth or decline vary by company, but regulatory approvals, commercialization, milestone payments, royalties, and collaborative arrangements are common factors that contribute to revenue growth. The net income of a company experienced fluctuations between two specific periods. Initially, on page 113, it decreased by $38,225 due to a significant increase in license and other revenues and interest income, while operating expenses increased moderately. However, this trend continued with an even larger decrease of $38.24 million on page 154, resulting in a consolidated net loss. The profit margins also underwent changes during these periods. On page 113, the improvement was attributed to the increase in license and other revenues and interest income. Although not explicitly stated, it can be inferred from page 123 that there was a decrease in the net loss percentage from 2024 to 2025. Several factors contributed to the decline in profit margins. The potential downward pressure on drug prices due to reduced demand or bidding procedures used by regional healthcare authorities and individual hospitals posed a significant threat, page 28. Additionally, increased rebate liability under the ACA, revisions to Medicaid rebate formula, and AMP definition also negatively impacted profit margins. The decrease in profit margins can be attributed to various factors. Increased rebates for Medicaid programs under the ACA, mandatory discounts for certain Medicare Part D beneficiaries, and annual fees based on pharmaceutical companies' share of sales to federal healthcare programs all contributed to this decline, page 28. Furthermore, negotiated prices for products covered by Part D prescription drug plans being lower than U.S. market prices also had a negative impact. Regulatory inspections and potential fines, additional clinical trials required by the FDA, uncertainty in market opportunities, and patient population estimates further exacerbated the situation. In conclusion, the net income of the company experienced significant fluctuations between two periods, with a larger decrease on page 154, resulting in a consolidated net loss. The profit margins also underwent changes, with an initial improvement on page 113, followed by a decline due to various factors such as increased rebate liability under the ACA and mandatory discounts for certain Medicare Part D beneficiaries. The company's financial performance indicates a lack of positive operating cash flow. According to the provided data, the net cash used in operating activities has been consistently negative over the past 2 years. In 2025, the company utilized $193,817 in operating cash, while in 2024, this figure was $142,055. These numbers suggest that the company is not generating sufficient revenue to cover its operational expenses, resulting in a net outflow of cash from these activities. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, the debt level increased by $110 million due to a loan agreement entered into on December 30, 2024. This increase was followed by a minor adjustment of $1,155 in long-term debt, bringing it from $108,940 to $110,095. However, when considering total debt levels, including investments, the company saw an increase from $549,441 to $549,774. On the other hand, interest expenses have been on the rise. The company experienced a significant jump of $1.4 million in interest expenses from 2024 to 2025. This trend continued with increases reported on multiple occasions, including a notable rise from -$10,090 to -$11,459. Notably, there was one instance where interest expenses decreased by $621, but this was an isolated incident amidst the overall upward trend. Overall, the company's debt level and interest expenses have seen significant changes over the past year, with interest expenses being the most notable area of change. The management of the company is optimistic about its future outlook and strategy. The key focus areas include developing a franchise of small molecule orexin receptor 2 (OX2R) agonists to address neuroscience diseases, which will drive the growth of the company's product pipeline. In terms of funding, the company has sufficient resources to support operations until mid-2028, with additional funding options available through loans and strategic partnerships. However, this may lead to significant increases in expenses as the company scales up its clinical and regulatory capabilities, establishes a sales and marketing infrastructure, and expands its intellectual property portfolio. The management is also aware of the risks associated with collaborative arrangements and incentivization agreements, but believes that these will ultimately yield rewards. The commercialization strategy involves developing and commercializing products in various countries, which will enable the company to generate recurring product revenue and become profitable. Overall, the company's strategy is centered around developing its product pipeline, securing funding, and expanding its commercialization efforts to achieve long-term growth and profitability. The acquisitions and divestitures made by CENTESSA Pharmaceuticals plc are significant transactions that have shaped the company's portfolio. In terms of acquisitions, the most notable is the proposed transaction with Eli Lilly and Company, which would result in Centessa being acquired by Lilly. This takeover offer requires a bidder to make an offer for all outstanding ordinary shares, or ADS, to acquire 100% control. Additionally, schemes of arrangement have been proposed, which require approval from a majority of shareholders voting at a meeting and representing 75% of the ordinary shares voting for approval. The proposed Lilly transaction would see Centessa Pharmaceuticals plc being acquired by Eli Lilly and Company. This acquisition is expected to bring significant benefits to both companies. On the other hand, divestitures have also been made by Centessa Pharmaceuticals plc. One notable example is the discontinuation of the clinical development of Elbone 101, a conditionally tetravalent PDL-1XC-D47 bispecific monoclonal antibody. Furthermore, the company has limited the out-license of its lockbody technology platform to Genmab for up to 3 targets. These divestitures demonstrate Centessa's strategic decision-making in optimizing its portfolio and focusing on high-priority projects. The company's financial activities have been documented in various sections of the report. One notable aspect is its dividend payment history. According to page 99, the company has indeed paid dividends, indicating that it distributes a portion of its profits to shareholders. However, when it comes to share buybacks, the situation is less clear-cut. While there is no explicit mention of share buybacks in most pages, page 45 does discuss the repayment of debt as a form of buying back debt rather than shares. This suggests that the company may be prioritizing debt reduction over share repurchases. That concludes the financial summary for Centessa Pharmaceuticals plc. Feel free to comment below, and I will be happy to answer them when possible.